Good morning, everyone. The intraday reversal that we saw on Tuesday was not good, and everything that I've been warning about this market for the past 3 weeks, despite us being near or at all-time highs in all the major indexes, kind of showed themselves with the fake out breakout to new highs in the S&P 500 and the Dow Jones Industrial Average as they reverse on heavy volume. I warned that a low volume uptrend likes to do this. I've constantly said a healthy market does not look like this, then like this, then like this, and that, this, and now maybe what we're going to see again. But you'll notice here that we like to slowly move higher and then take the elevator shaft straight down whenever we do sell off. A healthy market actually would look more like this. One up day, up 1 to 2%. 3 down days, total about 0.5%. Then another big up day, anywhere from 0.5 to 2%. Then 3 more days of drifting sideways, then maybe another up day of 0.5%, followed by another up day of 1%, followed by 4 to 5 days of 0.10 to 0.20% pullbacks. So you would actually have less days that you're higher overall on the indexes, but by the end of it, it's a much healthier uptrend and it's way more sustainable than moving up 0.2, 0.1, 0.3% every single day for basically 12 straight days in a row and then having a big reversal like this. This is then how you have a 1-2% down day. So right now, while it's early and there's no reason to sell it all right now, you got to make sure your stops are tight. I am not going to have anything if this does get ugly. If it gets ugly into August, September, which there's no guarantee. If it doesn't, awesome. My stops are where they need to be. I still have plenty of long positions, and I'll take new long signals as they trigger. Great, awesome. But to not prepare for something worse would be foolish at best. So I'm going to go ahead and prepare. So make sure your stops are where they are. I'm not going to personally have anything if, let's say, all my stops get run other than this. Large gains, medium-sized gains, small gains, tiny gains, break even, tiny losses, small losses. There will be 0 medium-sized losses. There will be 0 large losses. My stops are now on every single stock exactly where they need to be to make sure that if this thing gets ugly, I'm protected. So with that being said, I only received 1 long signal following the market session on Tuesday, and ding, 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 I received 2 actionable hedges and an add signal. So let's get to the hedges first. First off, SPXU, SPXS showed up in multiple scans. SPXU gives more bang for the buck, so that's the one I'm picking. Bullish hammer candle reversal pattern, candle over candle, huge volume surge, BOP confirmation, pocket pivot point signal. With the market reversing like it did off the highs, this is an easy choice for me. I want to get long, limit order, 1476, the high of the day. And there's your stop, 1438. Now, if I have 100 shares, my stop at the low is only 50 shares. Whatever then the next day's low day is, that'll be wherever the next 50 shares go. But I'm not going to put all my stop. Sometimes there's some fake out signals, so I like to give some of the hedge positions rooms to potentially work higher. But SPXU is in my ETF scan and my price volume BOP surge scan, so it's a 2% of my account capital. But 1476, 1438, clear cut. And then a familiar position for us to take as a hedge signal, TECS, TEX. Clear cut hedge signal. You got the volume surge, you got the bullish reversal candle pattern after it hit new lows, reversed to close exactly where it opened. Good enough with that BOP surge. Now I wish BOP would have surged to above these levels, but this is a hedge. I don't treat it like a stock. Good enough that surge, good enough that volume, good enough that close, and that's what I need right now. So TEX, ETF, PVB scans, 2% of my account capital. Limit order 980, the high of the day. And there's your stop, 949. You can sell it all with a breach of 949. I'll be out of half. Whatever the next low is, then becomes my final stop. But these are gimme positions right now. I've already raised right around 20% cash during the past 3 weeks, as many of my partial stops have triggered. A lot of full stops also, as I've been taking profits on stocks that I've been long for a long time now and making sure that I lock in gains on any stock that ends up looking like Riley did. For instance, Riley's a full sell following Tuesday session. I still have some shares, 120 shares. So now my final stop on those 120 shares is that low a day there. CJ was also a full sell. It clipped all of my position, but if you're still long, that's it. 30.05 is the final stop. It goes below 30.05, you are out. Getting back to text, like I said, clear cut, 980, 949. Simple as that. UVXY, already have a starter position in this one, looking to add now. UVXY was in my ETF scan, my price volume BOP surge scan. As you can see, each time it surged on volume, you've got a pocket pivot point signal triggering either on the day or after. And it was also in my max green BOP for 5 days scan. So normally that'd be a 3% position, but it's an add signal, so it's 1.5% of my capital. I want to get long, limit order, high a day, 31.48. And there's only one stop level. You could use this low day if you want 28.25, but the final stop down here is 28.20. So 5 more cents to have it ultimately fail. So that's where my one and only stop remains, 28.20. And with UVXY, the same thing. If I have 100 shares on this ad signal, 50 get clipped below 28.20. And now with the VIX hedges, I pair them off differently, which is so stupid to do because these are depreciating assets. They seem to just decay no matter what, so I'm not sure quite why I do it. But volatility is a weird pony to try to figure out how to ride, so that's why I still do my partialing off. So if I have 100 shares, finishes below the low day, I'll have 50 shares. Finishes below the next low day, I'll have 25, then 13, then 7, then 4, then 2, then 1, then 0. So it's just the way that I do it. There's really no benefit. It just keeps me hedged as long as we continue to grind higher. Like I said, we get a 20% sell-off across the board. We bottom out, get some great new long positions. You're going to have 5% long signals. We'll have up to 10% long signals. I'm never sure if I'll put 20% of my capital in long position again. But not only will they be good signals, but if they trigger with the proper market coming out of oversold conditions, the odds of them working are extremely high. Right now, the odds of any long working on the long side is extremely low. We're in nosebleed territories with the VIX at all-time lows. You do the proverbial math. The only new long position is LVNTA. This one, you would think that this right here is its earnings win, but I don't know why it gapped up on 731. I checked FinViz, didn't see any news that day, but I am long BATRK, and I am long LBDRK, LBRDK, there we go, and it gapped up on 731, and it's Liberty Broadband, and this is Liberty Ventures, so I'm sure it had something to do with that. So following that gap up, it's consolidated nicely sideways. It maintained green BOP the entire consolidation. Then following this morning's earnings release, the stock initially dipped to reverse higher to print a bullish reversal hammer candle on candle pattern on heavier volume with a BOP confirmation. So in this market right now, that's a very pretty move. It's one of the best looking charts out there in my scans today. Still tonight on Maui. It's Tuesday still. Wednesday everywhere else. So I want to get long this stock. Now, it is extended. This stock only showed up in one scan, my Can Slim scan, as it used to be Can Slim. Not quite Can Slim anymore, but it does sport a 94 composite rating. That's because of the accumulation distribution, the sales profit margin, return on equity overall score, and it's in a part of a strong group relative strength overall right now, along with it having strong relative strength. It's only the EPS that's a little beaten down, but the earnings are growing, so it is there. So I want to get long, LVNTA, 60.24, first cut loss level, 58.97, final cut loss level, gap fill at 58.07. If you're a new trader and you decide to take this trade, it's all about risk control here. Maybe you just only have that one stop below Tuesday's low day at 58.97. Me, I'm willing to give it a little room because even if it does back and fill, the most I'm losing is 5% if it really screams through that 58.07 on that pair of the trade. So combined, the trade's going to risk me about 2.5%. And like I said, if we just even use the post gap up measured move, we're looking at a 20% move. We're looking at a well over 5-to-1 reward risk ratio, and that's what I'm looking at right now in this market if I want to take a long position. Low inherent risk, preferably under 5% or at 5%, and then more than 4-to-1 reward risk ratio. 3-to-1 isn't going to cut it anymore. 4-to-1 even doesn't cut it anymore. I need more than 4-to-1 to take longs in this tape. But right now, if you're a new investor, cash is king. I've been warning over and over and over about the seasonality. Last week, I noticed the short-term yield curve inversion and the oscillators on all of the indexes, the Dow Jones Industrial Average, NASDAQ, S&P 500, Russell 2000, Dow Jones Transportation Average are all trending lower, showing that momentum is to the downside right now. Don't fight it, everyone. Aloha.